7 easy money stocks to buy now. Oh, this is a fun video here today, folks. Okay, let's say on a figurative level. Okay, if my mom called me and she said, Jeremy, and she's never bought a stock in her life, but if she called me and she said, Jeremy, I want to buy 7 stocks. I can't touch the money for the next 4 years. What 7 stocks am I buying? That's this video here today, folks. We're going to get into this, okay? Now, what does it take to be an easy money stock? Hope you guys enjoy this as always, by the way. An easy money stock has 5 core things, in my opinion, that it has to have, okay? 1 is a great capital position. Got to be in a very strong capital position. Number 2, it's got to be a growing business. Number 3, it's got to have a proven management team. Number 4, it's got to have less than a 10% probability that that stock price goes down over the next 4 years. So basically, you know, if we jump 4 years in the future, what's the chance of that stock being down, right? And number 5, it has to have between at least 50% upside and 200% upside over the next 4 years, which means it's very undervalued at the moment, and there's a lot of room for growth, not just in revenues, net income, but also in valuation over the coming years, okay? And there's a lot of stocks I hold that I would not call easy money stocks. Several in my portfolio that I'm like, that's not an easy money stock. I think it might have huge upside over the coming years, but it doesn't meet those 5 criteria I just laid out for you right there, right? Yeah, I might be in those for a different reason, right? It might be that 10x opportunity. My best stock I've ever had, the stock that made me the most money and got me the biggest percentage return, I would have never called that stock an easy money stock, which was obviously Tesla stock, right? It didn't fit a lot of those criterias back when I was buying that stock. Obviously, it worked out tremendously, but it came with tremendous risk as well. That could have obviously went south when I was buying that stock in 2018, 2019, right? So that is something to keep in mind. But yeah, these stocks are you know, a wide open 3. Let's just call it that, and you're Mr. Curry, okay? So that's what I would describe it. If you wanted an actual example of what I would not refer to as an easy money stock, you know, there's plenty in my portfolio. This is one of them. You know, the Chef, I couldn't call that an easy money stock. You know, they don't have, you know, if we were just to run through the Chef, right? Are they in a great capital position? No, they're in an okay capital position. Are they a growing business? Sure. Do they have a proven management team? No. They have a chance to prove themselves over the next, you know, couple years here and get margins to a good place in cash flow and profitability, but as of today, they're not a proven management team, right? Do they have less than a 10% of probability of going down over the next 4 years? No. Do they have, you know, obviously huge potential upside over the next 4 years? Yes. So they only meet 2 of those 5 boxes. These other 7 stocks I'm sharing with you here today have all these boxes checked, right? And so that's just kind of something to keep in mind. Hope you guys enjoy this as always. I appreciate everybody for joining me. If you're looking to join my private stock group and join us in there, get access to the Discord chat, like the Palantir chat, the SoFi chat, the Tesla chat, all those. Get access to our weekly investor report, as well as all my different course curriculums. If you're looking for access for that, check out the pinned comment down there. Already, stock number 1 of 7 for these easy money stocks is Google McDougal. Yes, Google McDougal is the first easy money stock up here. So Google's had obviously a very tough year, right? Stock's down roughly 30% year to date. Google's very undervalued at this moment. It's trading at a PE ratio of under 20. Basically, Google should always trade at, in my opinion, between a 25 and a 30 PE ratio, at least for the coming years, because this is still a growth company. We do got to keep that in mind. And they're actually, it seems like a lot of these big tech companies are going to lay off on the ridiculous spending they have been doing and the insane amounts of new research and development and employees and all those things. It seems like they're going to chill a little bit for the time being. And so I think there's a high probability that a company like Google, for instance, is going to grow their bottom line at a faster clip from, you know, in 2023, 2024, than actually they grow revenue. So for example, let's say Google grows revenues 10% in 2023, just throwing that number out there, right? I think they could grow their net income potentially 12%, 14%, 16%, okay? Same thing with 2024 numbers. And so I think that's like that for a lot of the big tech companies, but I think Google McDougal is obviously just one of those, right? And in Google, you could obviously get Google Search, YouTube, the Google Cloud, which is massive, Android, like all those things are going to be much bigger just in a few years from now than they are today, right? They all are, you know, still just great businesses that continue to grow and thrive, right? So if we were to look at Google has a top 3 best balance sheet in the world, if not number 1 balance sheet in the world. I mean, just ridiculous. So yeah, I mean, like, it doesn't get better than Google pretty much when it comes to balance sheets. So yes, absolutely, they check off that box. Is it a growing business? Yes, absolutely. Do they have a proven management team? As proven as you can pretty much get. Is there less than a 10% probability the stock goes down over the next 4 years? Yes, it's very undervalued, and it's a growth company that has tremendous upside, right? And will the stock go up 50 to 200% over the next 4 years? Absolutely. And that's regardless of whatever happens in the economy, what happens in the market in general. So that's why that one fits the criteria. And I actually personally just started buying Google stock very recently here, you know, and it's just, it's too easy of money at this point in time, too easy of money. And I actually wouldn't be surprised if Google ends up eventually making a decision similar to what Apple made several years ago now, which is pay a dividend. They've never done it. I would not be surprised at all if in the next year or two they decide to at least start throwing shareholders a little bit of money. You know, you can just start out your dividend really small. It's not like you got to throw, you know, big yield right away. Yeah, I wouldn't be surprised at all, to be honest, if in the next year or two they end up starting to pay a dividend as well, which obviously would start to attract dividend investors, which is, you know, I think a segment that Google could be looking for as far as its shareholder base, to be quite frank. Okay, that's the first stock up here. Stock number 2 of these 7 easy money stocks is PayPal, PYPL. PayPal right now has a forward P under 20, which is just silly. That's the best way I could put it. They are the kings of kind of, you know, let's call it transactions, fintech, whatever you want to call it, okay? They basically own the number 2 and number 3 most popular apps in the United States of America in the finance category. They own PayPal and they own Venmo, which are 2 big growth engines. And when it comes to this company, when you're talking about forward P under 20, that's just ridiculous, to be quite frank. Now, the stock has obviously gotten hit. It's gotten hammered this year, and so the valuation's gotten much more compelling than we've ever honestly seen it at in pretty much PayPal's history as a public company. So this company, great capital position, phenomenal balance sheet in this company. Is it a growing business? Abso-dang-lutely. Do they have a proven management team? Abso-dang-lutely. Less than a 10% probability it's going down over the next 4 years? Yes. And does it have 50 to 200% upside over the next 4 years? Yes, absolutely, in my opinion there, right? When you're talking about a company that has a forward P under 20 in this category, where this should command a forward P of always 30 plus, easy. When you talk about the type of growth and opportunity this company has, like, that's just ridiculous. You know, PayPal and Venmo, like, those are still actually rather early day services. That's the thing I don't even think some folks maybe understand on Wall Street right now. And so, yeah, I absolutely love PayPal. And that's another stock like a Google that I've actually started buying. I started buying PayPal several months ago versus Google very, very recently. But yeah, I mean, PayPal, I never thought I could get it at these sorts of prices, and it's come down to these sorts of prices. I'm like, okay, give me some shares. And so I was definitely buying that one, you know, especially when it was in like the $70, $80 range. Oh my gosh, okay. So that's that one. Number 3 is 7 up here is Target, TGT. So if you don't know Target, massive retailer. They've done, of physical retail companies, I can't think of a company that's done a better job running their business, just to be quite frank, and expanding and getting all the companies that are growth that attract millennials and the newer generations that are, you know, let's call it entering the buying force. They've done just a phenomenal job. And if you are a company that sells into Target, it's a pretty big deal because Target is the most trendy, the coolest of all the big physical retailers out there. And they've just done a phenomenal job. Like, I've been nothing but impressed by the management team over the last several years, to be quite frank. Okay, here's the deal. Forward P of about 12-ish, somewhere around there, very undervalued. Dividend yield around 3% on Target at this point in time. You know, this is a gift that was given to folks this year. I mean, this stock being down 30% plus, that is a gift, especially if you are somebody that's a dividend investor. And keep in mind, you know, when you see that 3% yield, no one obviously cared about dividend yields in 2020 and 2021. But I can tell you, now all of a sudden people are like, hey, yeah, those dividend stocks, they seem pretty interesting, right? Because it's nice to be able to get that cash flow sent to your account every 3 months, isn't it? Especially when at a particular time there's no money being made necessarily on stock prices going up, right? And so that dividend yield is definitely pretty nice. And as somebody that might want to hold the stock for several years, right, you collect those dividends year in, year out. And with Target, they should be much more profitable next year than they are this year and the following year. And so therefore that dividend yield will likely be upped over, you know, future years. And the payments you will get every 3 months will likely be bigger as long as Target thrives, you thrive, right? And heck, you know, if you play your cards right, you might be able to shop at Target for free every year because you're collecting enough money off that dividend, right? That's kind of cool. It's like literally I'm shopping for free. I buy all my stuff at Target, and that dividend pays me out whatever I, essentially spend. That's pretty darn cool, right? So in Target, great capital position, growing business, proven management team, less than a 10% probability it's going down over the next 4 years, and 50 to 200% upside over the next 4 years. Yes, 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 and yes, okay, across the board there, Target. Already, stock number 4 of 7 up here for an easy money stock. What is it? It is Palantir. This is going to be the most controversial of all these stocks. I can guarantee you that. The most controversial. But I actually think Palantir is an easy money stock. Now, the reason this one's going to be the most controversial is a few reasons. One is it has a forward P of 45. So on this list, we have all these names that are, the valuations are, let's call it very, very cheap. A forward P of 45 looks very expensive, but remember, Palantir's just barely getting to like a profitability state where we can even start talking about EPS and all those sorts of things. Imagine where this company's going to be at 3 years out, 4 years out from now in terms of their earnings per share. It's going to be ridiculous. So, in terms of that forward P next year, it's going to come down massively if, let's just say, the stock price didn't move at all. So essentially, this is actually a very undervalued company at this point in time, actually extremely undervalued right now. And if I look at Palantir, great capital position. I mean, we're talking about a company that has $2 billion plus of capital just chilling on the balance sheet with basically no debt, right? Growing business, absolutely. I mean, the biggest question for Palantir, is it going to grow at a 20% clip a year for the next 4 years, or is it going to be 25% or 30%? I think that's the biggest question for Palantir, is what clip are they growing at? 3, proven management team. This company's only been public for a couple years now, but the reason I would put them into a proven management team is Karp's been leading this company for, basically about 2 decades now. And so, when it comes to this management team, it's not like they're brand new out there. They're still somewhat new to the public markets, and they're still making that adjustment 2 years in, right? And what it means to be a public company and lead as a public company. But they actually got a very proven management team there. Less than a 10% probability the stock goes down over the next 4 years. They're just going to, based upon their product, they're just going to keep acquiring customers. Very sticky product, and going to get much more profitable over the coming years. And the valuation's very low with a great capital position. That's why I think it's a very low probability this baby goes down over the next 4 years. And 50 to 200% upside over the next 4 years, absolutely. In a bullish scenario where, let's say, Palantir gets closer to 30% growth rates and increases their EPS dramatically over the next 3 to 4 years, that would be a scenario where they could actually eclipse that, and that might be the only stock on this list that I think could potentially, keyword is potentially, eclipse that 200% plus upside over the next 4 years. So yeah, Palantir, controversial. I really thought about this one a lot because I knew this one would be controversial to put on this list of these other stocks, but I really feel, based upon the criteria, it meets them all. And I just think there's a very low probability the stock's going down over the next 4 years. We're 4 years in the future. Is Palantir still an $8 stock? I don't think it's anywhere even remotely close to that, to be quite honest. So yeah, that's my opinion on that. And obviously they have the government business and the commercial business. Commercial's where massive growth is. Government is lets you sleep well at night type business. And yeah, so Palantir, I know it's controversial, but I had to make the list, okay? Stock number 5 of these 7 stocks, that's an easy money stock, is Meta. Yes, Meta. I mean, if you told me I had to put my money in one stock and couldn't touch, let's say I had to put every single dollar, completely unrealistic scenario. Let's say I had to put every single dollar in one stock for the next 4 years, and I couldn't touch the money, it would be Meta. If it was couldn't touch it, 4 years, it's just in there, can't do anything, it would be Meta. I'd put it over everything else, okay? Even though I feel like there's stocks that have more upside than Meta, it's just that downside and upside risk is just too attractive at Meta at this point in time. Obviously, they own Facebook, they own Messenger, they own Instagram, they own WhatsApp, they basically own the world. Just to be quite frank, almost every single person in the world uses at least one of those services, if not multiple of those services on a daily or weekly basis, okay? So when it comes to Meta, the stock's been absolutely devastated. It's trading at a laughable P of 11. It's hard to even fathom how undervalued this company is right now. And they also are working on the biggest project, in my opinion, in the world right now. There's nothing that is bigger than the metaverse opportunity, in my personal opinion. I don't even think people have begun to understand how much how much that's going to change the world, what it's going to do for business, and what that could do for Meta's business. I think I don't even think people like understand that quite yet on how big that opportunity really is, and how real, not just how big it is, but how realistic it is that the company's going to pull it off. Actually, I think it's actually a very high probability that they're going to pull it off. You know, it's one thing to try a pie in the sky idea, right, as a company, but it's like, what are your odds you're going to pull that off? In terms of Meta pulling off the metaverse, I'm actually very confident they're going to be able to do that. And the great thing with Meta stock is, Meta, you know, for the next 4 years, metaverse doesn't even have to be a thing. They don't even have to make any progress on that, and the stock price is still going to move up massively over the coming years. The metaverse is just it's like a call option basically on the company, which is kind of a beautiful thing. You know, I kind of look at it, you know, if I look at a company like I own, like a Tesla, right? And in terms of the robot, right? In terms of the bot, that's just a cherry on top. Like, Tesla doesn't have to do that to be successful. If they do that, great. That's just a cherry on top, right? And that's kind of the way I look at the metaverse for Meta stock. It's like that stock's moving up massively over the next 4 years, regardless of what happens in the metaverse. But I think they're actually going to pull it off, and I think that's the biggest thing that's actually being worked on right now of any public company in the world. And not by a little bit, but by a lot. And you really, I just implore people, like, if you don't really get it yet, really spend some time in understanding how big this can be for companies, how big this can be for businesses, how much this can help commerce, people in general, and just doing things that, you know, living in the future. Let's just call it that, okay? Now, in terms of Meta, capital position, top 5 balance sheet in the world, growing business, absolutely. Proven management team, absolutely. Obviously, they lost Sandberg, so that's a big loss there. But you know, she wasn't going to work there forever, right? Eventually, people have to leave a company. And so, you know, I almost feel like Sandberg wants to go into politics. I'll be completely honest. I really think she wants to go down that route. And so, you know, there's no way she could continue to be at Meta and be a major political figure. Like, this is not happening. It's way too big of a company and one of the most important companies in the world. Never mind that it's a risk to her brand, because anything Meta could be involved with that could be seen as a bad thing hurts Sandberg's brand as a potential politician there. So do keep that in mind, okay? If that's a route, once again, I'm just reading the tea tree leaves. That's my personal opinion, okay? Less than a 10% probability the stock goes down over the next 4 years, absolutely. And 50 to 200% upside over the next 4 years, abso-dang-lutely, okay? I mean, heck, this stock could go up 100% and it still wouldn't even be remotely close to actually 52-week highs on that stock. Do keep that in mind. So yeah, Meta, absolutely easy money stock. Number 6 of 7 up here. This is actually a tie. I put 2 companies in here from the 6th spot because they're actually somewhat similar. They're both retailers. One is Foot Locker, which obviously sells not just shoes, but clothing. I spent $300+ at Foot Locker this past weekend, so Foot Locker shareholders, say thank you, okay? I appreciate you as well, okay? But in regards to Foot Locker, we're talking about just silly PE of 6 on this company, roughly. They got obviously great relationships with several different brands. They elevate brands, so brands do want to, you know, continue to partner with Foot Locker because they're going to elevate your brand, the way the stores are laid out, the way they, you know, show the product and whatnot. It's phenomenal. And when it comes to this company, the valuation is just far too cheap, just far too cheap. And when it comes to Nordstrom, I also put them in the same category, and that's why I put them tied for 6 of 7. Nordstrom's just catering to a little different consumer. Obviously, Nordstrom, very, I guess you can say high-end, especially in their department store business. And when it comes to Nordstrom, they also have the Nordstrom Rack business, which is very successful as well. So, yeah, in terms of both those companies, both in good capital positions, both have growing businesses. They're not like some of these other companies in terms of their growth, right? It's going to be like single-digit type growth for both those stocks. But the valuation on those stocks are laughable. Like, look at the P's, look at the forward P's. It's a joke. In terms of proven management team, absolutely. Those management teams have been leading these companies for a long time. Less than a 10% probability those stocks are going down over the next 4 years, absolutely. And 50 to 200% upside over the next 4 years, yes, I absolutely believe both those stocks actually have tremendous upside. Plus, they're dividend payers. Keep that in mind. Ooh, a little dividend money as well, okay? So, yeah, like both those. Okay, number 7 of 7 stocks up here. What is it? Corsair Gaming, CRSR. Corsair has a forward P of under 10 on this company, which is ridiculous. And, you know, it's a gaming hardware play. This is also streaming hardware, things like that. They're also getting into full-blown, like, laptops and stuff like that now, and even, like, PCs. I think they're going to go big time. with everything over the next few years. I think they're actually going to transform. I think they're doing it kind of on the DL. We're actually going to transform this business into just an overall massive hardware tech company. That's where I see things going. And like, it doesn't matter what you want, they're going to provide it for you. And that's where I see Corsair going. And with their strong brands, I think they can do it. And with their innovation and the way they run their supply chain, I honestly think they're going to be able to pull it off. So I think people are not even viewing this in the right light, in my personal opinion right now. And so when it comes to Corsair Gaming, the valuation is just silly now at this point in time. Great capital position, growing business, absolutely, especially you know, next year, right? 2022 is a year for the company to forget. Horrible year for the company. Great growth ahead in 2023, 2024, and future years. You know, just got to get past this year, essentially. Proven management team, absolutely. You know, Andy Paul's been leading this company for like 600 years, okay? He's done a great job with the company, growing it from literally nothing to becoming $1 billion plus company. And I think they're just literally at the start of kind of what they're going to pull off over the coming years. Less than a 10% probability the stock goes down over the next 4 years, yes. I mean, based upon the growth I see for this company and the fact that the valuation is ridiculously low right now. We just talked about a Ford P under 10 right now. Come on, man. 50 to 200% upside over the next 4 years, absolutely. You know, could it eclipse at 200%? It's a possibility. It's certainly a possibility. I don't want to get too ahead of myself in regards to that, but I think in order to pull that off, they would have to not only have net income go up quite dramatically over the next few years and their revenues as well, but I think the way the company is looked at would have to be different. They would have to become more than just a electronic hardware company. Because whenever you're just viewed as a hardware company, you're going to command a lower valuation. It's going to be hard for this company to command a PE, forward PE over 20, if that's the way people view it. If you can talk about the company maybe over the next 4 years becoming not just a hardware play and software play, that's where you can start talking about different valuation metrics and maybe commanding over a 20, you know, forward PE and things like that. So that just kind of takes time to play out. So those are the 7 easy money stocks that I believe have extremely low downside over the next few years and have very nice upside over the next few years. Let's just put it that way. Hope you guys enjoy this. As always, let me know if you own any of those stocks discussed in today's video. If you're looking to join us in the private stock group and get access to everything in there, once again, that will be pinned comment down there. I appreciate every single person that subscribed to the channel. Much love as always, and have a great day.